This is the Asia Trade. I'm Shery in Tokyo.
I'm Haidi, Stroud-Watts in Sydney. The top stories this hour. Futures are pointing to a positive open for Asian stocks as traders await a US jobs report that could flick the switch on a jumbo Fed rate cut this month. Broadcom slips in late trade as a lacklustre revenue forecast signals slower demand for non-AI products. Intel, meanwhile, said to be considering options for its stake in Mobileye. And the US imposing new export controls on cutting-edge chips and computing technology. It's the latest salvo in its tech tussle with China. We do have the South Korea current account numbers just crossing the Bloomberg now. The current account surplus for July narrowing to just over $9 billion US dollars, $9.132 billion US dollars. The goods trade surplus narrowing to $8.495 billion there as well. This comes on the back of an assessment from the Bank of Korea suggesting that the economy shrank as initially estimated. Still, though, the expectation of about mid 2% economic growth for 2024. We have seen South Korean exports, obviously that global bellwether of trade, maintaining quite a bit of resilience. Both investment and exports, in fact, for the South Korean economy has sort of turned out better in the previous quarter, the second quarter, than had previously been seen there. So seeing there the July current account surplus of $9.13 billion, narrowing there in the month of July. Shery.
Yeah, we'll be watching those chip stocks in South Korea because they have already been recovering. Of course, we saw Nvidia also rising for the first time in 3 sessions overnight. We'll be watching chip stocks across Asia because we have the Nikkei falling to a 3-week low. We have a strengthening Japanese yen, which continued to strengthen overnight. Of course, we also had comments from a BOJ board member talking about the need to continue those rate hikes. We'll be watching a few deals also across Japan. Of course, we have 7&I potentially telling Couche-Tard that its offer price is insufficient, that they don't really reflect the true value of the company. So given those comments from sources, we are going to be watching that stock, also Nippon Steel on its potential takeover of U.S. Steel. But it's really what happened in the overnight session and how we're setting up for the payrolls data, right? Because here in Japan is the expectations of rate hikes, but in the U.S. is expectations of those rate cuts. So we are seeing now traders pricing in more than 100 basis points of rate cuts, and even the likes of Citi and JP Morgan thinking, could we see an outsized 50 basis points rate cut at some point this year? We're seeing Nikkei futures or NASDAQ futures at the moment falling 0.3%. So we continue to see the downside pressure in Treasury yields, also in U.S. stocks, although some of those mega cap tech names did rise in the U.S. session. It's really about expectations of that make or break payrolls numbers coming out on Friday.
Yeah, certainly, Sharon. Economists surveyed by Bloomberg are forecasting a bounce in US hiring, a tick lower in the August unemployment rate. Garfield Reynolds leads our Markets Live Asia coverage and joins us now for more. So how are markets really setting up for expectations? Because obviously the sort of shadows of the potential volatility that we could see again looms large.
Yeah, you definitely get a sense going into this print that equities in particular are worried that there's going to be something that will not be good enough to be able to set aside last month's print. The last print was a real shocker. That was the one that got people saying, look out, recession is almost here, it's on the doorstep. So the forecasts going in are okay. More than 100,000 jobs to be created, the unemployment rate to tick back down. If we get something in line, I'm not sure that's going to be enough to help equities. It might even hurt them because that would raise the potential that the Fed only cuts 25 basis points and that the bond market will be basically telling you that that only 25 basis point cut will be a mistake, a policy error. That won't be enough to turn the economy around rapidly enough. So an inline result might therefore still be taken as bad news by stocks. Stocks want probably want an unequivocally good report, one that says effectively, well, if the Fed only cuts 25 basis points, that's going to be just fine. That might cause some bond pain, but I don't think that would worry stocks too much because yields have come down so far, so fast over the last little while that a little bit extra tick up in yields, that's not going to hurt. Equities are very, very keen to get reassurance that the US economy can execute the famous soft landing. And at the moment, everybody's feeling that the ground is a little bit too close for comfort.
Yeah, I always thought that given the importance of this payrolls data, that it was sort of a lose-lose situation any way it went. But then I saw this survey by 22V Research that says most investors think the market reaction will be risk on. So is the market just being too optimistic at this point?
Well, I think it's more that they've been a bit too pessimistic, perhaps. They think, there's been a lot of bracing for worst possible outcomes. I do think that partly reflects the fear that is out there, but it's one of those things where you look at how data has been going overall. The services PMI and ISM both came in pretty reasonable, and that's a much bigger part of the economy than manufacturing. Manufacturing's not been doing so well. So you look around, the holistic picture for the data, it's not that bad. It looks like the US economy is doing okay, and yet shares have sold off. So those fears are there, and if you talk to investors, if you get them to sort of step back and say, well, if jobs doesn't reinforce the bad news idea, then are we in a good place? They're like, yes. So there's definitely the potential for a bounce back. It's just, I think the hurdle for a bounce back is perhaps a little bit higher than it might otherwise have been because of the level of fear that's being demonstrated by investors at a time when, let's remember, equities are still pretty close to the record peak that we saw in July. And again, even though NVIDIA bounced back overnight, it's a long way down from its peak. That magic factor of the AI boom has faded in its power, and investors are left wondering what can drive us to fresh highs from here.
Alfred Reynolds, who leads our Markets Live Asia coverage there. Our next guest is underweight equities, believing that a soft landing is not locked in. Isaac Poole is the CIO at Ascalon Capital and joins us now from Hong Kong. Isaac, really great to see you as always. So you're saying that you don't actually even need to see recessionary conditions to really warrant the re-rating of certainly US equities and perhaps by extension global equities as well. So how cautious are you being right now?
We're being pretty cautious. I think what you've seen over the last 6 to 7 months has been equities really re-rate higher to valuations that are now, by most measures, very stretched. And we would characterise that as pricing in a re-acceleration in growth. These are PEs or multiples that are saying not only are we going to get a soft landing, but the Fed's going to pull off a sort of landing that allows us to re-accelerate very quickly and justify forward earnings expectations that are now quite high. And the economic data are simply not pointing that way at the moment. We're seeing a lot of downside risk. We're seeing genuine slowing in the labour market. We're seeing genuine slowing in the consumer sector, genuine slowing in manufacturing. And it's really difficult to see what's going to allow some stiff re-acceleration over the next 12 months.
And you're loading up on treasuries right now, I see, and that with the expectation of emergency easing in next year.
That's right. So we've been favourable towards treasuries for some time, and we only have to go back a few months when the 10-year and the 2-year were about 100 basis points, 1 full percentage point higher than where they are now. And they've moved lower as markets have moved to price in the risk of emergency rate cuts. They've gone well beyond pricing in these sort of surgical, precise rate cuts that people had been hoping from the Fed towards emergency, and we think that's quite probable next year. If the economy does slow further, we think the Fed is going to have to get rates down towards neutral, which we think is around 3%, and probably below. Otherwise, it's going to be very difficult to achieve a soft landing, and a hard landing becomes more and more likely.
What do you make of the demand that we're seeing for these corporate bonds? Because we are now seeing this record 2-day issuance when it comes to volumes, and it seems every company is just pulling forward their timelines, given that they just want to lock in those yields.
I think that's right. You're seeing both pretty good demand and reasonable supply coming through as people are trying to lock that away. I would suggest being really cautious here, because spreads both in investment grade but certainly in sub-investment grade or high yield are really tight, and they are not compensating for the risk that we see further slowdown, further weakness in the economy. And in parts of the US economy, you are seeing genuine credit weakness that hasn't spread across to the credit sector yet. But we think it's quite plausible we could get out towards 2025, the middle of the year, and see spreads materially wider from where they are now. And so if you are looking to go into credit, we would suggest being in the most high-quality credit you can get, and relatively short spread duration. Don't take on that interest rate risk or the spread risk.
In your notes, you're saying that complacency, whether it's from the Fed or the market, is the #1 risk. But at the same time, you think that long-term fundamentals are strong. So what's wrong with being a bit more complacent and being more risk-on when eventually we are expecting the U.S. economy to hold up?
Yeah, I mean, I think that's right. The complacency risk is that the Fed either cuts too little and allows the economy to weaken faster than they can get ahead of, so they get behind the curve, or that that we simply don't see a re-acceleration enough to justify the types of valuations that we're seeing at the moment. And so, yes, we probably will, towards the end of 2025 and 2026, start to see lower rates impact the economy and support growth, and see maybe at least stabilisation, if not re-acceleration, through 2026. But there's a long way between now and then, and equity markets are forward-looking, but not necessarily 18 or 24 months forward-looking. And in that interim, there's a real risk that they see earnings growth disappoint, and not just disappoint by a little bit, but disappoint by a lot. And that's really the downside risk, I think, that you need to be aware of in the sort of nearer to medium term.
Isaac, the Japanese yen continues to strengthen, of course, a function of what's happening in the U.S. as well, but also because of all of these messages that we're getting from the BOJ, a board member now saying that, we continue to need those rate hikes. What do you make of the messaging? I mean, they hiked rates, but then they came back, and then they said that perhaps no hikes when the markets are unstable, that they're watching the markets closely. Where does the BOJ go from here?
I think they possibly started to make a bit of a rod for their own back when they really did blink when the market challenged them at the start of August, and kind of stepped back from the possibility of further rate hikes. And now we are seeing, perhaps with a little bit more or a little less volatility, them raise the option of hiking again. But the window's rapidly closing, I think, for them to be able to meaningfully hike rates, to normalise and to give themselves the opportunity to have something to cut if the global economy slows. And so from here, yeah, we might get another rate hike from the BOJ, but I don't think we're going to see a string of them. And in reality, I don't think their economy has achieved a sort of escape velocity yet that guarantees that they can decouple from the rest of the global economy. So through 2025, I think there's quite a lot of downside risk for their economy, and we could see a Bank of Japan that's forced to cut next year.
Isaac, always great to chat with you. Isaac Poole, who's the CIO at Ascalon Capital. Coming up on the Asia trade, Amundi's Asia CEO joins us now for their view on China's investment landscape, live from this year's Bund Summit in Shanghai. Plus, Maybank Asset Management will tell us why they're liking local currency bonds in Indonesia and Singapore. This is Bloomberg.
Take a look at how some of those big chip names are trading in the after-hour session. Broadcom, Nvidia are both down. We heard from Broadcom slumping after the revenue forecast trailed the estimates. Nvidia was up on the Wall Street regular session, but we're now seeing it fall about 0.9%. Of course, we had double-digit declines for Nvidia. I mean, they did say that the report on being subpoenaed by the DOJ because of antitrust issues was actually not happening. They hadn't been subpoenaed. But we have seen the stock under pressure after those disappointing results on lofty expectations, the caveat there. We're also watching Intel because sources are telling us that Intel is considering options for their stake in their struggling automated driving systems provider Mobileye Global. So, Haidi, the chip sector, again, will be in focus in the Asian trading session.
Yeah, and of course, the sort of bifurcation of tech and how chips have really become kind of this pressure point of politics as well, front and center as we head towards the November US election. And the Republican presidential candidate Donald Trump has pledged to cut the US corporate tax rate to 15%.
It's nowhere near the number, but it has got to be.
Trump has pitched his agenda to Wall Street and corporate leaders in New York, and this quite clearly is a tax plan that marks a sharp reduction from the current 21% rate, which was actually part of Trump's own 2017 tax law. So quite the reversal here. But the former president also says he will establish a task force to review federal expenditures to be led by Elon Musk.
I am promising low taxes, low regulations, low energy costs, low interest rates, secure borders, low crime, and surging incomes for citizens of every race, religion, color, and creed.
Hedge fund billionaire John Paulson says he believes the Fed has waited too long to cut rates. He also gave us his outlook for the US economy and explained why he's pushing back on the current levels of immigration.
The immigration policy is a negative for our economy. If you look at New York City, we have hundreds of thousands of immigrants, which are costing the economy valuable resources that existing taxpayers are paying for. So we have to provide health care benefits, housing benefits, food benefits, and these workers aren't allowed to work. So I don't think the illegal immigration has been a benefit to American workers. It increased the supply of cheap labor, which held down wage growth for American citizens.
But wage growth has been part of the inflationary story, has it not?
Wage growth has been grown less than inflation. That's why real wages have declined.
I also want to talk about interest rates. Because at the end of the day, there has been a lot of concern on Wall Street about what a Trump administration would mean when it comes to the Federal Reserve. There was, of course, that Wall Street Journal report a number of months ago that questioned whether the Federal Reserve would remain independent. And then we also had the former president commenting in an interview with Bloomberg as well, saying that the president can certainly be talking about interest rates because he has good instincts. That doesn't mean he's calling the shot, but it does mean he should have a right to talk about it like anyone else. Do you share that concern that he could potentially damage the reputation of the Federal Reserve as an independent organization?
No, I don't share that concern. I think it is important for the president and the White House and the Treasury Secretary to comment on economic policy, including interest rate policy. But ultimately, the decision is up to the Fed. But it's important for the Fed to hear other viewpoints and to make sure the Fed policy is in sync with overall fiscal policy.
To that end, what do you believe should happen with interest rate policy through the end of this year?
Well, when you look at inflation now is somewhere around 3%. Interest rates are 5%. So real interest rates are too high. So the Fed, I think, waited too long to bring interest rates down. So I think the likely course of action is going forward is the Fed will start to cut interest rates.
What should they be by the end of 2025?
It's difficult to predict, but my best guesstimate would be around 3%, perhaps 2.5%.
Paulson and co-founder John Paulson speaking with Bloomberg's Shonali Basak. Now, Broadcom continues to be under pressure in the after-hour session. They missed when it came to the revenue forecast. Let's get more on Broadcom's numbers and bring in our tech reporter Annabelle Drulers in Taipei. Belle, so are we seeing just more signs that demand is not quite there when it comes to non-AI products?
Yeah, and that's really been sort of a consistent theme. I mean, the recovery that you've seen in the semiconductor market certainly hasn't been uniform, and you've seen particular weakness coming through in ones that are used for consumer electronics and the automotive space as well. And that really showed in the latest Broadcom forecast for the fourth quarter, because it was quite tepid or sort of underwhelmed. So even though actually we saw the AI component doing better than expected, it was the non-AI part that, again, it disappointed some investors in the market, because Broadcom doesn't just make money from AI chips. They've also got other offerings as well around data center storage, different types of software that are used for various other use cases. And so that is really what led to that sell-off in late trade, as you said, that disappointing sales figure, quite a slump we're seeing there.
We're also hearing, Belle, that the US is imposing new export controls on critical technologies.
Yeah, so this is a very different story that we're also tracking, of course, and these critical controls or export controls relate primarily to quantum computing and various other chips and different equipment parts as well. But the focus here on quantum computing, and it does actually bring the US into lockstep with some of its allies that are already targeting exports of quantum computing technology in key areas. We've seen the US, for instance, or rather the UK, Japan, the Netherlands, others in the market as well. That focus really is shifting to quantum computing now. So the US is sort of just catching up here to some degree, but certainly an area to be tracking given the advancements we're seeing in this field.
Yeah, so why that focus on quantum computing then?
Yes, it hasn't grabbed perhaps so much attention as other areas, but quantum computing certainly carries a lot of key benefits. And just thinking about quantum computing as a whole here, I mean, it's a totally different type of computing. It uses different methods to calculate, for instance, but it certainly differs and departs from classical computing. Now, it certainly does carry a lot of benefits to it. It could really lead to a lot of huge advancements in fields like finance, agriculture, health, I mean, a lot of different applications. But the risks here is that quantum computing could also be used to decrypt the mathematical calculations that form the basis of the modern day internet, modern day data storage as well. And that is the key concern here, that if you have quantum computing advancements that are in the hands of bad actors, that it could be used to destabilize essentially a lot of different areas. And so that is why that focus is now shifting to it, even though quantum computing developments are still sort of in their early stages. We don't actually have any real quantum computers right now. It's prototypes at this stage, but people just talk this could be within a few years, a few decades even. But certainly web scraping could already be happening now, where data is being stored to be decrypted rather at a later date.
Annabelle Jewellers there in Taipei. More ahead on the Asia trade. This is Bloomberg. Watching commodity markets as we head into the end of the week. This is a 5-day look at what's happening with the Brent. We're down about 5.5% this week. Could be the worst week in over 6 months and would make an 8th week of losses over the last 9. This as the risk-off mood really undercuts OPEC.
We have breaking news out of Japan right now. We are getting the July household spending numbers. They have risen 0.1%. It's really below expectations right now because household spending was supposed to rise about 1.2% according to economists. It's still turning positive from contraction for the past 2 months. It's still positive for a second month this whole year. So it is a positive trend, but it's still missing the expectations of economists at this point and barely rising 0.1%. Of course, we had real wages now in Japan turning positive. We saw it unexpectedly rise positive for a second month. So we are wondering whether that will translate into households actually going out to spend, Heidi. But at the moment, it seems for the July number, it's still spending rising only 0.1%, which is way below expectations.
Yeah, whether households are going to go out and spend is really kind of a big question, not just for Japan, but of course for a lot of the other countries in different parts of the economic cycle, right? Certainly that's an issue when it comes to Australia and weighing into the level of hawkishness that we still see from the RBA, despite the sort of cost of living challenges and the impact that we've seen on growth slowing. Sydney futures, regardless though, setting up for a little bit of outside as we get into the start of trading this final Friday, and of course a lot of nerves sort of being frayed ahead of the non-farm payrolls, given the form that we've had in terms of its sparking volatility, but lots of pressure, in particular when it comes to US assets, the dollar as well. Sydney futures up by about 0.1% there. We're seeing Singapore Nikkei futures trading higher for a pop at the open, 1.25%. We're seeing this sort of broader rebound could be quite regional. We're seeing in Australia, of course, that midweek loss was pretty bad, but we've been seeing quite a bit of upside, and those stocks are quite sort of close to record highs there still as well. On the macro front, we are kind of still watching any signals from the RBA. We did hear from Governor Michelle Bullock saying that the RBA will struggle to maintain the sort of positive labour market data if inflation remains persistent. Shery.
Right, let's turn to one stock that we're focusing on today. Nippon Steel being left hunting for alternative growth options, with President Biden planning to block its $14 billion takeover bid for U.S. Steel. For more, let's bring in Tokyo Bureau Chief Isabel Reynolds and Bloomberg Breaking News Editor Gareth Allen. Isabel, let me start with you and what the reaction has been here when it comes to this Nippon Steel deal.
Well, it's definitely been one of dismay in Japan. I think one story that we'd heard sort of off record from Japanese officials over the past few months was they felt that President Biden was forced to take this stance during the election campaign, but that after the election things might change and there might be more flexibility. So the fact that he looks set to sort of make this decision, set it in stone ahead of the election, I think is disappointing for a lot of people in the Japanese government. The comments that have come out have been fairly muted, but of course the very outspoken Kono Taro, who's currently in the race to become the LDP president and therefore the Prime Minister of Japan, has been very outspoken in criticising it and saying governments should not be stepping in a way that sort of distorts the markets.
What can we expect then from the two companies, because they don't seem to be backing down at this point?
So far, they're not admitting that this is over. Both sides are saying or implying that they might take legal steps to try and overturn any decision that comes out. Their chances of success, frankly, don't look very strong at the moment. It would be, I think, more or less unprecedented for a CFIUS decision like this to be overturned by a private company. So we'll just have to wait and see. But for the moment, they're not backing down.
The two countries often sort of tout as being fundamental issues to regional security, right? How would this potentially play out?
Right, yes. Well, I mean, the two countries always refer to their own relationship, their alliance as the keystone of regional security and even beyond Asia. So this is a very important relationship for both sides. But I think the Japanese would have to admit that they probably rely a little more on the US for defense purposes than the other way around, obviously. So when it comes to whether Japan would take some steps in in any kind of backlash against this decision, I don't think that's very likely. But what they will be keen to do is to keep talking and to make sure that this kind of thing doesn't happen again. This kind of economic cooperation is not sort of blocked at any time in the future.
It's a busy week in the Tokyo Bureau, isn't it? I mean, we're not just following Nippon Steel and U.S. Steel, we're also following the 7&I potential deal there, because we're hearing that the board is said to be planning to tell Alimentation Couche-Tard that its offer price is insufficient and that competition law concerns remain. Gareth, of course, is here with us still. So, Gareth, what do we know right now?
Yeah, that's right. So Nikkei last night reported that 7&I was set to tell Couche-Tard that their offer wasn't good enough, and we're expecting this morning that there will be a letter that will come from 7&I and be sent to Couche-Tard telling them that the offer's not good enough and that there's still concerns over the competition issues with the deal.
So where do we go from here? Because this, if it had happened, it would have really made a global convenience store giant.
Yeah, it certainly would have. But the 7-Eleven has already been pushing back. They've already been approaching the government to try and protect themselves against the takeover. They're trying to say that they're a special company in terms of foreign exchange and trade laws, and try to defend against that issue. The other big thing that's been happening, of course, is the exchange rate at the moment has been coming back to yen strength. So the price of a potential deal for Couche-Tard is actually getting more and more expensive, and there's even been analysts saying that there could be a potential for 7&A to reverse it and actually take over their potential suitor as well. So it's they're very much up in the air at the moment. There's much to watch in the coming days over this deal.
And over Nippon Steel as well. So Gareth Allen, Isabel Reynolds, great to have you with us with those two big potential deals that we're watching here in Tokyo. We do have more ahead on the Asia trade. This is Bloomberg. South Korea wants to welcome 20 million foreign tourists by the end of this year, banking on the rising popularity of its music, films, and food. But the numbers are currently stuck below pre-pandemic levels due to a slowdown in Chinese visitors. We spoke exclusively to Cultural and Tourism Minister In-Chon about how the government plans to sustain the Korean wave.
Well, I personally don't think the investment is that large. In fact, I think it's still not enough. From my point of view, I don't think it's the peak of the K-content industry in Korea. I think it's about getting over the hump. So I can see the top of the mountain now, but there's still some way to go. So now I think we need to invest more money and effort and focus investments in developing people. Of course, the economy is not good globally, and the Korean government is also being more austere right now. So we have been spending a lot of money on welfare and improving people's quality of life. We know that we need to invest in culture, but we are cautious about it because it doesn't produce fast results. So I think we invest a lot, but I still think it's not enough. We need to do more.
How are you strategizing to make sure that your investments are reaching small and medium-sized businesses?
Most of the time, the big global productions are being taken care of in the marketplace. Even if we don't provide any government support, there are already a lot of financial institutions in the US or in other countries, including a lot of global funds, and also in Korea. From our point of view, it's actually the small and medium-sized independent films that we need to invest in, because they give us a lot of room for experimentation, including with manpower issues and other challenges that support the big film industry. There's an invisible added value that comes out of it. We can't see the economic effects right away, but those advantages can have ripple effects.
How much is the growth of K-content helping the broader tourism industry?
We think it's having a significant impact on tourism because people are curious about Korea after watching dramas or movies, performances by our K-pop idols, or other things like our webtoons or games. And I think people keep connecting with Korea, whether they want to learn to speak Korean or maybe even come to visit. Especially with movies and dramas, many things that we can see, such as makeup, give rise to the beauty industry, fashion and other things. And Korean food is attracting a lot of attention too. So we're seeing more exports of noodles, kimbap and dumplings. All of this is the power of culture. It doesn't show directly, but it's seeping through.
The government is hoping to attract 20 million tourists this year. How close have you come to that? And how much is China's economic uncertainty impacting that goal?
지금 현재까지 한 1,000만 명 정도의 관광객이
We've had about 10 million tourists so far this year, and we're aiming for 10 million more by the end of the year. But I wonder if that's a little bit difficult because it's so hot right now, and it's difficult to move around the world. Still, the tourist arrivals are steadily increasing right now. Chinese tourists are not visiting as they were before the pandemic. It's recovered quite a bit, but the biggest problem we have with tourism now is the visa issue. So if we actually just open up, we would have a lot more people coming. But right now, quite a few countries have some visa requirements. We know it's inconvenient, and it's the Ministry of Justice and other ministries that are managing these visas. So we're still negotiating. We also still lack a lot of infrastructure, hotels, transportation, things like that, to be able to take in a lot of tourists. So we have to overcome that. The fact is that even if we had a lot of people coming now, we probably could not accommodate them all.
A cheap yen is leading to a tourism boom in Japan. How much competition is that for Korea?
그러니까 오히려 지금 우리 한국 국민들이
We have a lot of Korean people travelling to Japan right now. We can't do anything to discourage or stop them from going to Japan because it's nearby. And now that the yen has gotten much cheaper, we're probably enjoying that kind of tourism as well. So what we're trying to do is to actually incentivise them to travel a lot more domestically. We're trying to identify famous things and places that we can introduce to people and keep them informed about it.
지금 Mpox가 또 이제 확산되고 있다고 국제 사회에서 좀 불안한데.
There's anxiety in the international community over infectious diseases such as Mpox. How's the government assessing this?
지금 정부는 대비를 하고 있죠. 지금 왜냐하면
Right now, the government is preparing because we didn't have the vaccines and things like that in advance when the coronavirus pandemic happened. So we're working right now in the early stages, now that we're hearing some rumblings that it could happen and cases are actually increasing a little bit. So we're being proactive right now and making sure that we have all the money for this one and making sure that we're prepared.
South Korean Culture, Tourism and Sports Minister In-Chon speaking exclusively with us in Seoul. You can watch any of our past interviews. TV Go is your function. You can also watch us live. There you can dive into any of the securities or Bloomberg functions that we talk about and become part of the conversation by sending us instant messages during our shows. This is for Bloomberg subscribers only. Check it out at TV Go.
Especially, Shery, as we continue to get that analysis and really the expectations going into the US jobs report, right? It is expected to show that bounce in hiring, a steady in the labour market. We are still seeing quite a bit of caution, if steadiness, when it comes to the start of trading in Asia this Friday as well. Some pressure, in particular, when it comes to US stocks and US assets like the dollar, of course. But across Asia, we are seeing Sydney likely to open up if that indicated view is to hold a little bit softer in the Friday session. We have seen a recovery from that worst decline since August, middle of the week, but we do still continue to see that weakness when it comes to some of the iron ore and the broader miners on the back of the weakness in commodities. Taking a look at Singapore Nikkei futures, we're trading high by about 1.4% there. So equity futures there a little bit more optimistic for Japan. The yen has also stabilised after that rally this week as well. S&P futures looking pretty flat at this point. Also watching bonds as well, Shery, with Australian bonds looking like they'll have a pretty steady session ahead of that US payrolls data.
Yeah, I mean, such an important make or break number, right? Especially after what happened with the July payrolls numbers when we saw the August 5th meltdown. And right now we're getting more indications from labor market indicators that we could see a soft print. Still interesting that most investors think the market reaction to the data will be risk on, according to a survey of 22V Research. What I've been paying attention to, you mentioned commodities. I've been watching the price of oil. We are seeing WTI right now in the Asian session recovering for the first time in 5 sessions. But the fact that it still remains below that $70 a barrel level, the fact that we got some bullish signals for oil overnight, we're talking about OPEC Plus delaying that planned output hike. We're talking about the EIA data showing that crude inventories in the U.S. have fallen by almost 7 million barrels last week. And we're still not seeing that big of a reaction in the oil market. Just comes to show you the investor concern right now about demand, about really the broader economic outlook. And you can see Brent right there down more than 5% so far this week. Now, this would set it for the worst week in over 6 months and the 8th week of losses in the last 9 weeks. We have more ahead on the Asia trade. This is Bloomberg. China is combining two of its largest state-backed brokerages to create a new industry behemoth. It's part of plans to consolidate the $1.7 trillion sector and build stronger investment banks to compete with overseas financial firms. For more, our China correspondent Mingmin Lo joins us now. So what do we know at this point?
Yeah, so these two firms, Guotai Junan and Haitong Securities, will be merging in a share swap deal. That's according to the company's statement. It's still pending regulatory approval as well as approval by shareholders and board members. But if this goes ahead, it will bring the company's total assets to about 1.6 trillion yuan, which puts them above CITIC Securities to become the largest brokerage in China. And this comes about a year after President Xi had urged regulators at a financial conference to nurture a top crop of investment banks in China to be able to compete with Wall Street banks expanding into China, especially after Beijing had liberalized the sector to allow full foreign ownership in the sector in 2020. Now, we're expecting more deals, more mergers and acquisitions to come in the coming years because more companies are vying to be the top 2 to 3 banks that are prioritized by policymakers to be able to compete with global peers by 2035. That is a goal that has been set by the securities regulator in China.
Comes as the sector's been hit by, a huge slump in profitability.
Yes, the sector really has been in the doldrums for a few years now. If you look at the Bloomberg Compound Index of about 25 brokerages listed in mainland China, that has been down about 20% over the past 5 years. You have stocks slumping because of weak economic outlook. The earnings outlook also not looking very bright. If you look at CITIC Securities, for instance, they reported declines in earnings in the first half. The same with Haitong, down 75% in the first half of this year. And this sector has also been the target of President Xi's Common Prosperity campaign, with banks asking employees to tighten their belts, some banks resorting to pay cuts and layoffs to really consolidate their business. And look, this is a sector that still has about 145 brokerages as of the end of last year. So there's a lot more room for this supply side reform to go on, because while China's stock market is the second largest in the world, their brokerages still lag far behind their global leaders like Morgan Stanley and other big firms, U.S. firms. Their market caps are above $150 billion. But CITIC Securities, for instance, is only about a fifth of that size.
Bloomberg China correspondent Mingmin Lo there. We have breaking news here in Japan. We are now hearing from the 7 & I board. We had been reporting that they would respond to that offer by Alimentation Couche-Tard. Right now, the board is responding, saying that they conducted a careful and comprehensive review, that the Couche-Tard offer price was $14.86 cash, but they're resisting any proposal that deprives the intrinsic value of the company. The Couche-Tard offer price was $14.86 per share in cash again. The proposal is not in the best interest of stakeholders. This is after 7 & I's board says they reviewed and discussed the proposal. The 7 & I board has unanimously concluded, based on the unanimous recommendation of the special committee, that the proposal is not in the best interest of shareholders and other stakeholders. 7 & I saying that the deal opportunistically timed and it's grossly undervalued. It grossly undervalues the company, according to 7 & I. We had been reporting that we were expecting the board to send a letter to Couche-Tard today, that they were not happy with this deal. Of course, that we were expecting that response is finally come. We will be watching whether we get the response from Couche-Tard. But as expected, Haidi, 7 & I not too happy with this bid, saying that it was opportunistically timed and it grossly undervalues the company.
Yeah, very strong language there, despite expecting, of course, this communication to be made. We've heard from analysts saying, well, the silver lining is that maybe discussions continue, that, if it is just about shareholder interest in mind, that, this isn't sort of just a facade in terms of not wanting a deal. That further obstacle and complication, of course, is that the Japanese government can block the deal or ask for changes on those terms as well, given the suggestion that it's important for national security. We'll continue to watch that story, but let's get you some of the other corporate stories stories that we're following. Bloomberg learning that Intel is weighing a sale of part of its majority stake in Mobileye as part of a major strategy overhaul to improve in performance. Sources say Mobileye has a board meeting later this month and Intel's plans will be considered. Shares of the struggling automated driving systems provider slumped in US trade. Software billionaire Larry Ellison will take control of Paramount Global after a group led by his son David completed its purchase. The Oracle co-founder is backing his son's $8 billion proposal, and a filing shows he'll take almost 78% of the Redstone family's interest in the film and TV company. Sources tell us Shery Redstone will get $180 million in severance and benefits from the deal on top of hundreds of millions more from the sale of her stock. AstraZeneca shares fell in London. Bloomberg reporting that Chinese police have detained 5 of the pharma giant's current and former employees. Sources say the individuals being held are all Chinese citizens who marketed cancer drugs. The company says it's aware of some of its staff in China being under investigation, but has no further information to share. Heading into the market opens in Sydney, Seoul and Tokyo next, quite a degree of caution as we head into those non-farm payrolls numbers out of the US, of course, could have huge implications in terms of where the Fed goes next. This is Bloomberg.
This is the Asia Trade. We're counting down to Asia's major market opens, and we're counting down to the payrolls numbers out of the U.S. Of course, Haidi, that is a make or break number. We saw the volatility that the July figure really brought to the broader markets globally. So really all eyes on what happens with that labor market data.
We're worried about labour market data when it comes to Australia as well. Michelle Bullock from the RBA saying that we could see a worsening of the jobs market if inflation remains stubbornly high. And of course, we continue to watch developments on the corporate front as well. Some very interesting language from Seven & I when it comes to responding to Couche-Tard's proposal.
I mean, we were expecting them not to be too happy when it comes to Couche-Tard's proposal, but now they're saying that that bid really grossly undervalues the intrinsic value of the company, saying that it's not for the best interest of stakeholders. We'll be watching how 7 & I opens, but right now we're seeing the Nikkei, a little bit of a rebound there, up 0.5%, as we continue to see a stronger Japanese yen towards that 143 level, and really a function of what's happening on that other side of the trade with the U.S. dollar, especially given expectations of more Fed rate cuts, of course, and how the setup looks for that U.S. payroll number. The 10-year JGB still below that 0.9%. We've had also commentary coming from a BOJ board member talking about the need to continue hiking rates. But take a look at how 7 & I Holdings is trading at the moment. We're seeing downside of about 2%. Again, we were expecting them not to be too happy. We had heard from sources that they were really seeking government protections from that Couche-Tard bid. But finally, they've responded, and unanimously the board is saying that the bid undervalues the intrinsic value of 7 & I, and that Alimentation Couche-Tard's bid really doesn't take into account how crucial 7 & I Holdings is, and it's obviously convenience stores around Japan, how crucial that is to Japanese life. Take a look at how the Korean stock market is coming online as well. Of course, we had seen broad pressure. We had seen a little bit of a rebound when it came to those semiconductor names. We saw Nvidia rising in the overnight session on Wall Street, but we're seeing a little bit of pressure in the after-hour session. The Kospi down 0.2%. Not a lot happening with the Korean won, 13.34 against the U.S. dollar. Haidi.
Yeah, obviously US stocks and other assets, really in particular the dollar, are going to be in focus as we get these non-farm payrolls through later on in the course of the day. But take a look at how we're opening. This is a staggered session, of course, as we get into the opening moments for the ASX. We're seeing pretty flat trading at the minute. Of course, quite a recovery we've seen since that Wednesday sell-off. The Aussie dollar is pretty steady at 67.40. We did have quite a bout of dollar weakness and sort of vulnerability going into the morning session from overnight, and watching treasuries of course, as we saw sort of not much of a change when it comes to Australian bonds going into this session. That 10-year yield for Treasuries overnight falling about 3 basis points. Some of that was on the ADP data, the private payrolls numbers falling short of economists' estimates. We're also watching some of the sort of, I guess, indications of risk and confidence coming from the oil market as well, given that even the sort of potential OPEC move and some of these supply side disruptions are not really boosting confidence to a meaningful extent. We're seeing Brent trading up by about 0.25%, but we're looking like we're set for an 8th week of losses out of the past 9 for oil. Well, economists surveyed by Bloomberg are forecasting a bounce in US hiring, a tick lower in the August unemployment rate. Garfield Reynolds leading our Markets Live Asia coverage and joining us now for more. Not a lot of margin or room for error here.
Well, we've got a situation where traders are seeing about a 35% chance for a 50 basis point cut. So you effectively got a situation where if the jobs numbers come in line with expectations or better, then that will move back down towards a 0% chance of a 50 basis point cut. Traders will bet on the 25 basis points. If we see a miss, then we very rapidly move to 50% and above. Even just moving to 40% and above, usually when you're looking at these sort of things, anything less than 40% or above 60%, that's, it's not on or it's on. So moving into that, 40 to 60% range means there's a good chance. It's a coin flip or maybe slightly better. Mm-hmm. So that's the setup we're looking at for the rate cuts. For stocks, in a lot of ways, the signaling, at least out of equities, has been what they really want to see is an economic situation that fits with a 25 basis point cut, that fits with Powell going, yes, we need to ease as we head for a soft landing. If it's a 50 basis point cut that's on the table, that's going to worry a lot of people in equities, especially after the NVIDIA endless, relentless rise and rise, and all that signified for the AI boom after that stalled out. That's one of the things that's got equity investors very worried about. Where do we find the next driver for sustained gains?
How big of a driver will the U.S. payroll numbers be for Asian markets? Because we just saw the extreme reaction with the yen carry trade unwind as well after the July report.
Yeah, well, the yen's going to be a very important factor, in that, both because of the direct impact that the yen has on Japan's stock markets, and Japan's stock markets, remember, have been leading the way higher for most of this year until what went on a month ago. And the yen in particular, we've had Ueda re-emphasizing that he'll hike rates if the economy keeps developing the way that they had expected it to. So you've got a relatively hawkish BOJ and the potential for a dovish Fed. So that's why the yen has been gaining this week. It's stalled out now while we wait for non-farm payrolls. That raises the stakes. If we get very bad economic news out of the US, that's going to send the yen climbing rapidly. That's going to set off the sort of volatility that people don't really want. Even if, to be honest, a lot of investors might think that if there are declines in Asia in response to a bad payrolls number, that it's worth that's worth buying into, because the overall picture in the US is not really that bad, and they would be reassured that the Fed is willing to act to try and relieve any serious slowdown. So, honestly, a weaker US dollar is usually a help for Asia. You might actually find that this time around, even if there is a strong downside reaction in the US, there's less of a follow-through in Asia unless, as I said, the yen really takes off, if we get fresh carry trade unwind action going.
Garfield Reynolds, who leads our Markets Live coverage there. Now, China's annual Bund Summit is getting underway in Shanghai with a theme this year of navigating a changing world. Our chief North Asia correspondent, Stephen Engel, is there. Steve, so set the scene for us.
Yeah, well, good to be back at the CF40 Bund Summit. Obviously, as the name implies, we're here on the banks of the Huangpu River on the historical Bund at the Peninsula Hotel. We have a number of great guests coming up over the course of this morning, including the former ECB President Jean-Claude Trichet, as well as the head of the AIIB out of China, Jin-Li Chun. But right now, we have Eddy Wong. He is the Amundi Asia CEO. Thanks for kicking off Bloomberg's coverage of the Bund Summit.
Good morning, Stephen. How are you today?
I'm doing very well. So obviously after a really kind of aggressive expansion phase for foreign fund managers, asset managers here in China, is there more pressure now for them, including you, to have sustainable profitability? 2022 was probably a very difficult year for everybody as the nation was coming out of COVID and COVID zero. How do you see your prospects and what are your priorities?
Thank you for the question. First of all, we had a great first half, especially in the second quarter. So I think India has been performing very well. China actually is recovering very well. Hong Kong, SAR, Korea, Japan, Southeast Asia, Singapore, they are all doing pretty well. So despite a very challenging first half in terms of the market backdrop, a lot of the uncertainties, I think first half Amundi Asia has been pulling off pretty well.
Well, how do you navigate, obviously, what has been a prolonged slump in this economy?
Well, I think, if we look at the flows, I think the flows are pretty much diversified. We are seeing flows from institutional clients, retail clients. So, I mean, in terms of asset classes, I think people are continued. Well, I guess what I'm going to say is it's an uncertainty market. People are not sure what's going on in the next 6 to 12 months. People have a lot of speculations, but at the same time, they are not like just waiting. We are seeing people continue to deploy money to us, with us, and they are continue to wait for the best time to continue to invest.
How about assets under management? I'm just seeing Amundi, as of 2021, managed about $120 billion in China, Hong Kong, and Taiwan. Yep. But Greater China Chairman, Mr. Zhong, admitted 2022 was challenging. But we did see, assets under management up about 19%. Yes. You have a stated target for Asia Pacific of $500 billion. Yes. Yes. 250 here in Greater China. Yes. Where are you on that goal? Okay, so we are now at about 450, 460, with a total group AUM of about $2.3 trillion. So Asia accounted for about 1/5 of the total assets. We see a strong inflows from passive. I think year-on-year basis, globally, if I'm not mistaken, growing at about 23%, active at about 8 to 9%. So overall, again, I would say it's a pretty diversified portfolio. Greater China among Asia obviously accounted for a big part of it. But again, growth is everywhere. How optimistic are you, though, and how does that reflect in potential hiring? The last numbers we had was about 400 employees in China, including in the joint ventures with Bank of China and Agricultural Bank.
Yep. Well, I would say cautiously optimistic. Still a lot of uncertainties. We are no way of cutting down our presence. In fact, I think our group CEO just reinforced the idea at the June big summit in Paris that Asia is the top driver of Amundi Group. So I'm very comfortable in that.
What areas, what sectors would you prioritize for growth? I know your chairman talked about the pension schemes and programs here in China. I believe last year we learned Amundi, BOC, Bank of China Wealth, was in talks with regulators to join the private pension program where people can put in, about 12,000 yuan per year. Where are we on that?
Well, if I may put it in a slightly generic way, we are obviously client-centric. And the market has been changing very quickly. In terms of policies, it's very hard for us to know when it's going to happen, when it's not. I think our key focus in the next 12 months for Asia would be more passive/ETF. I think I see a lot of demand in terms of doing building blocks, in terms of doing asset allocations, in terms of finding lower cost tools. And I think Amundi is in a great position in the sense of providing such tools to the investors.
Well, talk a little bit more about the pension plan. I mean, I think it was UBS who said by 2060, this is going to be a $25 trillion industry. And I know these are some of the tax-sheltered plans that some of the other foreign asset managers have. Maybe some of them have even unwinded those positions. Are you seeing those same challenges? What are the biggest challenges? I know it's regulatory, always in China regulatory, but what are the biggest challenges? Given the size and the potential.
I think that I wouldn't say it's a challenge, but it's always like in China. You just have to do all the work and wait at the finish line, and then wait to see when you can actually cross the line. So I think for Amundi it's the same. We just get ourselves prepared. We never know when foreign firms like us is going to be able to get into the pension market. But I think we are beefing up our capabilities, getting the right people, setting up the foundation.
What about the latest, speaking of regulatory issues, the CSRC mandated some, fee cuts and also caps on remuneration for executives and also fund managers. What's that done to morale and retention of talent?
So for Amundi, for our JVs, no impact. I don't know whether that's good and bad, but we do see a lot of the talent, the pool of talent is growing. We do see a lot of good talent looking for opportunities with us. Again, we are long-term, we are committed, and we are in an expansion mode. So we are looking for different caliber talents joining us, beefing up our foundation, getting ready in terms of our product offerings, go from there.
Eddy, Wong, thanks so much for joining us here on Bloomberg Television this morning. For Amundi Asia CEO, Europe's biggest asset manager with more than $2 trillion under management. Thanks so much for your time.
Thank you, Steve.
Here in Shanghai. Okay, guys, we have much more coming up the rest of the morning from the Bund Summit in Shanghai. Back to you.
Our Chief North Asia correspondent Stephen Engle there on the ground. Take a look at how we're setting up. We're just about, 15 minutes away into the start of trading across major Asian markets. Of course, really counting down to the non-farm payrolls numbers, which could potentially kind of show a bounce in hiring, a steadying in the labour market as well. We're seeing 165,000 as the forecast roll for payrolls, I should say, for numbers, and a 4.2% unemployment rate being expected as well. But of course, last month's report sparked that big growth scare and that sell-off across financial markets. So it's no wonder that we are seeing that sort of correlated caution as well. But at the moment, we are seeing a little bit of just modest upside when it comes to trading in the Nikkei 225. We're watching that 7&I story in particular, really taking a bit of a dip, the plans, and we have seen that sort of response in terms of their communication to Couche-Tard that the proposal is too low, amongst a number of other issues they take with that proposal. Still ahead, we're taking a closer look at the US imposing new export controls on critical technologies and its bid to curb China's ambitions. The latest next. This is Bloomberg.
Take a look at how Asian chip makers are trading at the moment. A little bit of a mixed picture as we're seeing Samsung gaining 0.1%, but SK Hynix down more than 1%. SK Hynix has really closely moved alongside Nvidia. Nvidia rose in the overnight session but was pressured in the after-hour session. And of course, we had Broadcom also slumping after its revenue forecast trailed estimates. Of course, we continue to see that demand slowing for non-AI products. But let's get more on those numbers and bring in our tech reporter, Annabelle Drewlers in Taipei. So, Belle, what were the key takeaways for Broadcom?
Well, it really, Shery, related to the forecast that the company gave for the fourth quarter. And as you said, there's the AI component and there's the non-AI component. But looking at the forecast in total, so it was for $14 billion, the company said, for sales. The estimate on Wall Street had been for 14.1. What's interesting is when you take a look at the AI part of that, so sales are expected to be about $12 billion. Again, from AI-related sales or chip sales, the estimate had been for 11.8. So that shortfall that you're seeing between 14.1 and 14, what the company actually provided for its forecast, suggests that that shortfall is coming from the non-AI service or non-AI chip sides at Broadcom. At Broadcom, of course, it's involved in other areas. It's got mainframe products, security and data center software. It's also invested or has offerings from the mobile phone chip, data storage gear as well. So lots of non-AI components to the business. The CEO, of course, addressed this in the earnings call, and he said that these sort of sales are actually at their worst point or even perhaps through their worst point, because he's saying when you take a look at bookings that give that indication of future sales, they're actually trending upwards. So the worst could be over, but still, of course, that stock really slumped in after hours.
And other than stocks that we're watching, we're also hearing that the US is imposing new export controls on critical technologies.
Yeah, that's right, Heidi. And this really focuses quite closely on quantum computing in particular. So it's relating to that area, some semiconductor goods as well. But what's happening here is that the US is really just getting into lockstep with some of its allies, Japan, for instance, the Netherlands, that already have these sorts of restrictions in place. As I said, the rules, they target quantum computing components or computers and components, some advanced chip making tools and other sort of advanced technologies as well. They do cover all worldwide exports. This sort of measure that's been put in place, or this announcement, means we're going to have sort of a 60-day response window for countries and different organisations to respond to the possible new restrictions coming through. But really that focus very much starting to come to quantum computing now, where we haven't really seen it perhaps as much before.
Yeah, why? Why is that?
Well, quantum computing carries perhaps a lot of different benefits. I mean, we're not talking about classical computing. This is an entirely new system or new ways of computing that are being developed. Right now, it's important to note that they are in development. We have prototypes in place, but we haven't actually seen a full quantum computer just yet. It does carry a lot of potential. You could see a lot of advancements that could be made in health, in finance, in agriculture, lots of different applications of quantum computing. The risk, though, as well, is that quantum computing has the ability to decrypt all of the sorts of data protection tools that are in place today. And so that, of course, means that you could see a lot of different trade government secrets possibly being exposed, especially if bad actors are already collecting that data quite easily right now. It could be decrypted at a later point. So certainly a big concern.
Annabelle Jewell is there in Taipei. Another story that we're following in India and Singapore have agreed to ramp up collaboration in digital technology, seeking a bigger role in global chip supply chains. Prime Minister Narendra Modi was in the city-state as agreements were signed to cultivate talent in chip design and manufacturing and boost Singapore tech investment in India. The tie-up showcases Modi's ambition to turn his country into a technology superpower. More ahead on the Asia trade. This is Bloomberg.
Seven and I reversing earlier losses and gaining more than 1% in the Tokyo trading session. It's now released a letter to tell Couche-Tard that its proposal is not in the best interest of stakeholders. For more, let's bring in Bloomberg breaking news editor Gareth Allen. What exactly are they saying?
Yeah, that's right. So after the news overnight that Seven and I was going to push back against Couche-Tard's offer, and they released the letter just a few moments ago this morning, and they said that it grossly undervalues the company. They said that they conduct a comprehensive review. The offer itself, we found out now, the offer was $14.86 per share. They said that that's a grossly, significantly undervalues the company. They said the timing is opportunistic, so they're obviously not particularly keen on their suitor, and they're really starting to push back severely on this offer from.
We had already seen indications of that pushback with potentially seeking government protection, right? It's interesting in the letter also they say our crucial role in Japan life needs discussion, how core they are to this economy.
That's
basically.
right. So I mean, Seven and I is really kind of appealing to the fact that they are a strategically important company for Japan and important for Japan's economic security, given the role that they play in the lives of Japanese people. And they've asked the government to designate them as what they call a core company under the Foreign Exchange and Trade Act, which would mean that the Couche-Tard would have to make a declaration to the government before they could go ahead with the deal. So we'll also be watching going forward to see whether the government actually accepts this appeal from Seven and I, or whether they'll push it back. So that could be a fairly crucial factor in this deal going forward.
Yeah, in that sense, it's sort of mixed messaging, isn't it? Because, is this encouraging that we expect discussions to be ongoing, that the price might be raised? If this is all about shareholder value, it's one thing, or are they still kind of hedging their bets on wanting that core designation?
Yeah, well, I think Seven obviously thinks that the offer is not enough. And the other thing, of course, is that the exchange rate in Japan is actually, the yen's getting stronger at the moment. So, Couche-Tard's offer, which was kind of at the real bottom of the yen, it's actually getting more and more expensive, this company. And Couche-Tard, of course, is smaller than Seven & I. And there's actually been analysts who have said that this whole thing, if the exchange rate goes in the direction it's going at the moment, could actually reverse, and Seven & I could go ahead and take over Couche-Tard instead of Couche-Tard taking over Seven & I. So, there are so many factors in this deal that we need to watch going forward. It's going to be fascinating from here on in.
Bloomberg breaking news editor Gareth Allen there as we see that flip-flopping when it comes to Seven & I shares trading in about half an hour into the start of trading in Tokyo. But take a look at how we are seeing European futures opening at the moment. Stoxx 50 futures are looking a little bit soft at the moment, and we are seeing German DAX futures off by just about 0.2% as well. Really a bit of a struggle for momentum, as we can see going into the US jobs data, and not expecting that we're seeing caution on that front as well. Watching some of the big oil names as well, as we did see OPEC Plus agreeing to pause their oil supply, but even that doesn't look like it's going to save Brent being able to sort of get away from that 8th week of losses out of the past 9. More ahead on the Asia trade. This is Bloomberg.
Heidi, the countdown is on for the U.S. jobs payrolls numbers. I think the countdown has been on for the past week or more since the July numbers really triggered that market meltdown, right? But really, it's about expectations of job gains, about 165,000 at this point. But we'll be really closely watching the unemployment rate, because remember, the July data triggered the SAM rule, the recession indicator, with the rate jumping to 4.3% in July. So right now we're getting some signals from the broader labor market data that we've been getting so far. For example, the ADP private employment tally that was out on Thursday suggesting a soft payroll for August. But usually the ADP report has been a poor sort of prognosticator of non-farm payrolls in recent years. But the correlation has been improving this year. So we'll be watching it very closely as well.
And of course, so much of this is going to feed through to expectations for the Fed, right? As Garford was just saying a little bit earlier, does this sort of just put into the 50 basis point bumper cut camp into overdrive? Does it pull that back? In which case, of course, we come back to 25. Does it sort of even overshoot that, and we get something even potentially more than 50 start to be priced in as well? But it's interesting. We're hearing the Fed, I should say, Chicago Fed President Austin Goolsbee speaking on Thursday to MarketWatch, saying that the trend of eco data justifies multiple rate cuts starting soon, that he sees more warning signs about the labour market. So we're seeing the dollar edging lower in response to those comments as well, given sort of just the hype that we see going into this jobs report. So it is no wonder that we're seeing kind of an outsized reaction when it comes to FX investors that are clearly feeling quite skittish and jumping at all the shadows, if you will, if you take a look at our MLive blog, just talking about that big reaction there. But it is also quite interesting because we've heard from the likes of John Paulson, the billionaire, saying that the Fed waited too long to cut rates. They are really expecting the Fed to lower them into the months ahead, perhaps around 3% or 2.5% for the federal funds rate by the end of next year. So there's a lot of speculation going around as to, what the policy is going forward. Has there been a policy misstep? And I guess we may know a little bit more, Shery, by the time we get the labour market numbers.
Yeah, we've already seen the reaction in the Treasury space, as you were watching right there, because the 10-year yield has been falling every session this past week. And it's really that expectation of more market volatility, especially in the corporate bond side, that U.S. blue chip corporate debt market has notched a 2-day record in sales. A lot of companies really bringing forward their issuances. Another 11 firms set to sell bonds. Nearly 50 companies, including Uber, sold a combined $72 billion worth of new bonds earlier in the week. And as I said, really trying to rush and trying to take advantage of the sort of open window for issuance. We have low borrowing costs and also healthy investor appetite so far. It's a dynamic that could potentially change with the Fed expected to cut rates later this month. Our next guest is slightly defensive on bonds, given the Treasury rally and the upcoming U.S. elections as well. Joining us now is Rachana, Mehta, co-head of regional fixed income at Maybank Asset Management. Great to have you with us. So tell us a little bit about being a bit more defensive, because we have seen this incredible bond rally. Could it have gone a little bit ahead of itself?
Absolutely. Like we have seen a 10-year Treasury at the beginning of the year almost about 4.3%, and today is about 3.7%. Don't mind that. We are still very bullish on duration, but we just want to take some profits here and wait for the job numbers today. Though I'm expecting slightly stronger number today, but eventually I do believe the 10-year Treasuries can come down to 3.5%. So even if you want to take a duration bet, it's better to go through 10 years rather than 30 years, given we expect a steeper curve and the U.S. elections are coming, and given that higher fiscal deficit trajectory for the next couple of years for U.S., we believe it's good to be at the 5 to 10-year part of the curve rather than 30-year part of the curve. Yes, we are currently defensive, but we continue to like short-dated high-yield bonds for carry. And we also like Singapore government bonds because we believe it's more like a safe haven. And the 30-year bond is currently yielding 3%, and I think it can go down to 2.5% over the next 1 year.
And we continue to see that bond rally in China as well. Are you looking into that market?
As of now, we don't have many positions in China because I feel if you look at the 10-year bond, it's trading around 2 to 2.2%. And I think given the Chinese government and the central bank don't want a big rally, they've been actually selling bonds in the market. So I feel it's very difficult for China's 10-year bonds to rally from here. So we are actually pretty neutral on Chinese government bonds. But we continue to like, say, Indonesian government bonds and Malaysian government bonds, more from a currency perspective, because we expect this currency to appreciate over a longer period. So we prefer Indonesia and Malaysia.
You do catch that weakening of the US dollar, particularly against the yen, against the yuan, some of the other Asian currencies. Do you worry about a repeat of currency and carry trade driven volatility that we've already seen this year?
I think it can come back, especially if you have a weaker job numbers. And one thing I've been observing is that actually the dollar deposit in the region, whether it's Thailand, whether it's Malaysia, Indonesia, has grown tremendously over the last couple of years, correct? Because the interest rate differential were in the favor of US dollars. Now, if Fed starts cutting rates, this interest rate differential is going to go away. So I think we'll have double whammy. This carry trade may really have like another tsunami in the sense that all this local deposit also will start getting converted into their own currencies. So not only from a trade perspective, from the dollar deposit, which has grown tremendously over the last couple of years in all these countries, can actually create a big rally in these Asian currencies. Yeah, so we are actually very bullish on Asian currencies for the next 1 to 2 years.
The defensiveness in the posture also comes ahead of the US election. I know that's one of sort of the reasons. Is it because of the risk of a higher fiscal deficit?
Actually, there are a couple of risks because it also depends on who comes to power, whether it's Trump or whether it's Kamala Harris. I think in both cases, there will be definitely higher fiscal deficit. But say, if Kamala comes to power, then maybe, hopefully, because she wants to increase taxes, then the deficit may not be a concern from a long-term perspective. So we need to see what it is. But definitely, US deficit is going to go higher. So actually, we do prefer GCC countries, high-quality AA single-A-rated bonds. At least it gives you enough spread to cushion for the treasury volatility. So if you want to take a duration on 30 years, I like high-quality IG bonds in the GCC region.
I mentioned earlier how it was really the highest two-day new issuance of corporate bonds on record so far, especially in the U.S. Are we going to continue seeing the appetite given just the sheer volume that could be out there already and given what we're talking about, the fiscal side of things?
I think definitely, I think people are also, remember one thing, all the pension funds students coming out, maybe moving there's some asset allocation from equities to bonds, correct? So definitely, despite this supply, I think people and a lot of retailers also have been buying equities over the last couple of years, if you look at it in the US. So if even the little switch comes from equities to bonds, definitely all the supply will be taken care of. So I'm not that worried about the supply from that perspective, especially if US economy is slowing. I feel that the asset allocation from equities to bonds also may create a bigger rally in the bond market eventually.
Rachana, really great to have you with us. Rachana Mehta, who's the co-head of regional fixed income at Maybank Asset Management. Take a look at how we're faring. We're just about 40 minutes into the start of trade across markets in Japan, in Korea and here in Australia, and quite a bit of caution ahead of the non-farm payrolls numbers, given, of course, there is still that concern that we might see a repeat of the volatility of the previous data release. But we are expecting to see that bounce in hiring, a steady in the labour market. 165,000 is a number for payrolls that forecasters are seeing, with a 4.2% unemployment rate being eyed as well. But hopefully we're not going to get sort of that revived spark of the growth scare that we had in the last month's numbers. We are seeing that skittishness, though, play out when it comes to trading in FX in particular, at edging lower of the dollar, just reacting a little bit to the Chicago Fed's Austin Goolsbee talking about more warning signs being seen in the labour market in a current interview. So saying that he sees essentially more concerns about the labour market, so potentially traders are wondering what he knows about the US jobs report and potentially what that says about possible weakness there. We spoke just a little bit about yuan volatility and the concerns over an unwinding of any carry trade. China's embrace of a stealthy strategy to manage its currency is exposing the nation's banks to billions of dollars of potential losses. For more on today's Big Take, let's bring in Asia FX and Rates reporter Tanya Chen. So, Tanya, tell us about what we're seeing when it comes to the swaps trade.
Yeah, it's a trade that's really ballooned during the time of high U.S. rates and cheap yuan funding, right? And it's kind of gone a little bit under the radar because it's been on that derivatives market. So the two sides of this trade, the China state banks, there's just been this abnormally high dollar demand to stabilize the yuan. And then on the other side, you've got hedge funds, corporates, any type of overseas asset managers or overseas entities that look to yuan assets but lending it out at their dollar rates. And what has happened is that you've seen this $100 billion buildup of short positions on the China state bank side, but it's become an investment opportunity for these overseas entities. For example, by lending out the dollars, they're getting about 3% from this trade, but then they could use the yuan and rotate that into these risk-free yuan assets, these NCDs, and they get another 3%. So in total, you're getting almost about 6%, which was higher than what you would get from T-bills at the time when this trade was at the most profitable.
Yeah, so tell us a little bit about that. How have these positions played out so far?
Yeah, so, you know, over the period of time when this trade was flourishing, you could see that the swaps trade made up about 1/10 of this Forex market. And at a point when the Chinese state banks were trading this very, very actively, they were trading this at about 8 times the average daily turnover. Going forward, I mean, if you're looking at what's happening now in the yuan and the spot market, obviously the dollar has softened quite a bit. And so you might actually see for the state banks, these $100 billion short positions could actually start to narrow their losses because the yuan is starting to gain. But experts that we've spoken to have said that this swaps trade will continue to really flourish even as the Fed rate potentially starts to come down. And that's because China still needs kind of these shadow intervention tools, especially going forward. I mean, a lot of the benefits from doing this kind of shadow FX intervention in the options market was so that they didn't have to dip into their Forex reserves. And if you go into the U.S. election ahead, there's a lot of risks, the tariff risks that are still kind of weighing over the yuan. So all in all, it's a win-win situation for the China state banks if the yuan continues to gain.
What's next for this trade, though? Would there be any signs that the PBOC might be concerned?
At this rate, no. As I said, I think this is a great tool, I think, for the China side in terms of being able to manage these currency volatilities. And as Rachana was saying, we do expect that the yuan volatilities could continue. There has been a lot of talk about whether or not these exporters and Chinese corporates will start to repatriate their flows back on shore. And so that might drive a lot of the near-term volatility ahead. But there's still yet some lack of certainty around whether the appreciation trend is actually set to continue for the yuan, because as you know, there's quite a lot of domestic hurdles and a lot of political risks that still loom large.
Our Asia FX and rates reporter Tanya Chen there. Coming up, our exclusive interview with South Korea's Culture and Tourism Minister In-Chon as the country has pledged record investments to promote K-pop, K-dramas, and more. This is Bloomberg. We're seeing broad downside across Korean assets, utilities, industrials, and tech leading those declines. The likes of SK Hynix and even Samsung turning more negative as the day progresses. SK Hynix down more than 2%. Of course, we had seen a little bit of recovery when it came to those chip makers yesterday, but despite the fact that NVIDIA rose in the regular session, we saw it under pressure after hours. We're seeing the broader chip sector across South Korea down again. South Korea wants to welcome 20 million foreign tourists by the end of this year, banking on the rising popularity of its music, films, and food. But the numbers are currently stuck below pre-pandemic levels due to a slowdown in Chinese visitors. We spoke exclusively to Culture and Tourism Minister In-Chon about the government's record investment to sustain the Korean wave.
Well, I personally don't think the investment is that large. In fact, I think it's still not enough. From my point of view, I don't think it's the peak of the K-content industry in Korea. I think it's about getting over the hump. So I can see the top of the mountain now, but there's still some way to go. So now I think we need to invest more money and effort and focus investments in developing people. Of course, the economy is not good globally, and the Korean government is also being more austere right now. So we have been spending a lot of money on welfare and improving people's quality of life. We know that we need to invest in culture, but we are cautious about it because it doesn't produce fast results. So I think we invest a lot, but I still think it's not enough. We need to do more.
How are you strategizing to make sure that your investments are reaching small and medium-sized businesses?
Most of the time, the big global productions are being taken care of in the marketplace. Even if we don't provide any government support, there are already a lot of financial institutions in the US or in other countries, including a lot of global funds, and also in Korea. From our point of view, it's actually the small and medium-sized independent films that we need to invest in, because they give us a lot of room for experimentation, including with manpower issues and other challenges that support the big film industry. There's an invisible added value that comes out of it. We can't see the economic effects right away, but those advantages can have ripple effects.
How much is the growth of K-content helping the broader tourism industry?
We think it's having a significant impact on tourism because people are curious about Korea after watching dramas or movies, performances by our K-pop idols, or other things like our webtoons or games. And I think people keep connecting with Korea, whether they want to learn to speak Korean or maybe even come to visit. Especially with movies and dramas, many things that we can see, such as makeup, give rise to the beauty industry, fashion, and other things. And Korean food is attracting a lot of attention too. So we're seeing more exports of noodles, kimbap and dumplings. All of this is the power of culture. It doesn't show directly, but it's seeping through.
The government is hoping to attract 20 million tourists this year. How close have you come to that? And how much is China's economic uncertainty impacting that goal?
지금 현재까지 한 1,000만 명 정도의 관광객이
We've had about 10 million tourists so far this year, and we're aiming for 10 million more by the end of the year. But I wonder if that's a little bit difficult because it's so hot right now, and it's difficult to move around the world. Still, the tourist arrivals are steadily increasing right now. Chinese tourists are not visiting as they were before the pandemic. It's recovered quite a bit, but the biggest problem we have with tourism now is the visa issue. So if we actually just open up, we would have a lot more people coming. But right now, quite a few countries have some visa requirements. We know it's inconvenient, and it's the Ministry of Justice and other ministries that are managing these visas. So we're still negotiating. We also still lack a lot of infrastructure, hotels, transportation, things like that, to be able to take in a lot of tourists. So we have to overcome that. The fact is that even if we had a lot of people coming now, we probably could not accommodate them all.
A cheap yen is leading to a tourism boom in Japan. How much competition is that for Korea?
그러니까 오히려 지금 우리 한국 국민들이
We have a lot of Korean people travelling to Japan right now. We can't do anything to discourage or stop them from going to Japan because it's nearby. And now that the yen has gotten much cheaper, we're probably enjoying that kind of tourism as well. So what we're trying to do is to actually incentivise them to travel a lot more domestically. We're trying to identify famous things and places that we can introduce to people and keep them informed about it.
지금 Mpox가 또 이제 확산되고 있다고 국제 사회에서 좀 불안한데.
There's anxiety in the international community over infectious diseases such as Mpox. How's the government assessing this?
지금 정부는 대비를 하고 있죠. 지금 왜냐하면
Right now, the government is preparing because we didn't have the vaccines and things like that in advance when the coronavirus pandemic happened. So we're working right now in the early stages, now that we're hearing some rumblings that it could happen and cases are actually increasing a little bit. So we're being proactive right now and making sure that we have all the money for this one and making sure that we're prepared.
South Korean Culture, Tourism and Sports Minister there speaking exclusively with Shery in Seoul. We are watching what's going on in Shanghai at the moment at the Bund Summit. We're hearing from the PBOC governor, the former PBOC governor, I should say, Yi Gang, speaking at this event, saying that the economic recovery is still underway but relatively slow, that aggregate domestic demand is weak and they need a proactive fiscal policy and accommodative monetary policy, that China has tried to fight deflationary pressure in recent years with emphasis on support for the real economy the way forward. And, you know, you're really addressing the fact that we continue to see just essential flatlining when it comes to consumer inflation in China. And, of course, deepening factory gate inflation has been a concern in recent times for quite a sustained period now. We're also seeing weakness when it comes to the trade front as well as a potential push for more fiscal stimulus. We've seen that the PBOC official who telegraphed triple R cuts before, seeing room to ease again, so potentially rate reductions and other policy adjustments still being necessary given the trend of the economy. And we're also seeing perhaps more room for fiscal measures as well. There has been a push for more issuance of local government and special government bonds, for example, but most economists see more as being needed to be done. So quite interesting that we're hearing from the former PBOC governor, Yi Gang, there expressing really that emphasis that more proactive fiscal policy alongside accommodative monetary policy is necessary with this recovery that he characterises as being relatively slow. More ahead on the Asia trade. This is Bloomberg.
These are some of the stocks that we'll be watching when markets open in mainland China. We are talking about those semiconductor names, given the Broadcom fell in late trading on a disappointing sales forecast. Of course, we had Nvidia also pressured in the after-hour session. So these are some of the names that we'll be following. But of course, trading will be impacted in Hong Kong, Haidi, because they've just raised their storm warning to the third highest level. We're talking about that typhoon signal 8. So we could see those flights being disrupted, not to mention trains and underground rail services running on a limited schedule as well.
Yeah, we see that Shanghai Hong Kong Stock Connect trading halted on the typhoon for the Friday session at least. So this raising of the storm warning to the third highest level as Super Typhoon Yagi skirts the city. Flights are said to be disrupted, as you mentioned. It's tracking toward southern China. So the typhoon signal 8 is what we're watching at the moment. And under the current rules for the stock exchange, Shery, that $5 trillion equity market will now cancel the morning trading session, we will have to wait to see what happens when it comes to the afternoon session, if the alert is lowered at noon. But I know, Shery, we've been through sort of some of these wild weather. It doesn't always kind of translate to being much when you're on the ground.
So many typhoons here in Japan as well, but that's it from the Asia trade. Our markets coverage continues as we look ahead to the start of trading in China. This is Bloomberg.